Hello, and welcome to this latest episode of the Friends of Sanctuary podcast. I'm Marianne Bartels, Chief Investment Strategist at Sanctuary Wealth. Today, I'd like to welcome our guest, Dan Schaefer, CEO of Cottonwood Residential. Dan, welcome to the program.
Thanks for having me here.
Now, we spoke a year ago.
It's been over a year, yeah.
And our viewers, I'm not going to expect our viewers to remember what your business is. So could you explain what Cottonwood does and what's your footprint?
Yeah, so the simplest way to think about us is we are in the multifamily or apartment business. We own mostly Class A, which is, higher end, nicer luxury complexes, mostly in the Sun Belt states. So we're big in Florida, Tennessee, Georgia, Texas, the Carolinas, Utah. And that's generally our footprint. We have a few other assets in other places, but generally places where people are going because there's a lot of job growth.
Now, the last time we spoke, multifamily wasn't in demand. Have you seen a shift in the demand for multifamily in the last year?
Let's talk about demand a little bit. So demand is really driven by job growth. And what I would say is that because interest rates have stayed so high the last couple of years, it's very hard for young millennials to buy homes. And so that's actually put a floor on demand. Demand hasn't fallen off like we thought it might. The thing that's hurting demand a little bit is there's been a ton of new deliveries. In every city you go to, you see apartment buildings being built. And, this is a boom really because of low interest rates before the Fed started raising interest rates. It was a confluence of very low interest rates and tons of high demand coming out of COVID. Way too many people started developing apartments, and we're actually hitting the peak deliveries right now. We're literally at the top of it. And what's interesting about that is we haven't really seen rents fall off. They haven't been growing like they had historically. They've been flat. New rents are a little bit down 2 to 3%, but renewal rents, people who are staying, which is, typically more than 50% of the residents, are actually seeing a little bit of growth because people don't like to move and it's a hassle to move. And so what you're seeing is a pretty stable demand scenario. And our belief is that as we roll through 2025 and into 26 and 27, the new supply is totally dried up. Like if you look at the new starts that were happening relative to what's actually being delivered, starts have just fallen off a cliff. And so as the stuff kind of, it takes a couple 2 to 3 years to build these things. So as it kind of works their way through the system and all those units get delivered, we believe that by the end of 2025, you're going to start seeing strong rent growth again. And most people that are in the market buying today are sort of buying on the promise that, hey, things are going to look really good in 26, 27, 28.
You know what's really interesting? Normally when you hear a lot of supply hitting, you expect price to go down, but you're saying prices are stable, which means there's still got to be demand is what you're talking about. And why don't you talk a little bit more about the demographics? What's your demographic footprint look like?
Yeah, that's a really good question. So typically in the United States today, the key renter is somebody who's between age 18 and 35. What's been happening in the last 20 years, these are kind of mega trends, is that people are waiting longer to get married. The average age of somebody getting married is pushing 30 years old today for men and 28 for women. That's up substantially from like the 1970s where, it was probably 10 years younger. This whole demographic has just been waiting on making life decisions. And also the millennials today are the largest cohort of that age group we've ever had in our country. And so you have this massive number of people that are potential renters. They're waiting much, much longer to get married. They're waiting much, much longer to have kids. And so historically, that demographic would have moved on and started buying homes and creating families. And so now you're having that age group kind of span longer and it's creating more demand. And also during COVID, you had a lot of people, that age group move home with their parents. And, people are kind of done with that. And there's a lot of unwinding happening, and the job market has been better than I think all of us expected. And so because there's jobs and there's unwinding and you have this massive demographic and throw on top of it, interest rates are very high and this group really can't afford to buy homes today, they're renting for longer, which is kind of putting a much bigger demand at a time when all the supply is hitting. So you would have expected actually the supply to push rents down. And it just really hasn't happened on a nationwide basis. Certainly in some markets that got really overbuilt, you see some rents down. But generally speaking, across the country, it's been an incredibly stable operating environment.
And then for our viewers, because we hear terms of demographics like millennials, I think what's important about the millennials is the size of the millennials is bigger than the baby boomers. And I remember listening to a person that did a lot of demographic work during the baby boomer cycle. And he said, they're going to impact housing. In this case, they're impacting apartments. They're going to impact the stock market because the need to invest. So I think the size of the millennials and the demand that you're talking about, I think, is quite significant. Would you agree with that?
I agree with that. I don't think that trend's going away anytime soon. Eventually, it'll peter out because we do have a demographic shift slowly happening at the younger age where we're not replacing as many people, right? Without immigration, and that's a political commentary I don't really need to get into. We're slowing down the growth. But right now, the millennials are huge. The generation below the millennials are huge too. You have more kids graduating high school now than you've ever had before. So it's clear sailing on the demand side for quite a while, but eventually we're going to run into a baby bust in this country. And these things take 20 or 30 years to play out.
So let's talk about the investment side, right? You're in the private markets, but there is a public market. And when we look at real estate in the public market, it's done fairly okay, even with the high interest rates, maybe half of the S&P return approximately. Can you kind of compare and contrast the private market versus the public market?
Yeah, I can. The publicly traded REIT market, at least in our space, in the apartment space, there are a handful of really, really large companies that are, 10 to $25 billion companies that own multifamily across our country. And, the public markets really bid them up, before interest rates started rising. Call it the peak was probably early 2022, mid 2022. Those companies from the peak fell about 60% in stock price value. So it was a massive correction. And we've seen,
especially as interest rates went up.
As interest rates started rising, you had a massive correction. These are the public stocks. But beginning early this year, as rates started moving the other direction, finally, you've had the beginnings of a recovery, and those stocks are up about 20% from the beginning of the year. So it's a pretty nice recovery, but obviously the fall was really big. And but you could also say the peak was maybe artificial, right? There was too much hype and demand at the top, and you get a little more volatility in the public markets than you do in the private markets. In the private markets, what you've seen typically with rates rising, you've seen values fall anywhere between 20 and 25%. So it's still been a pretty substantial hit to values. And obviously, depending on your leverage, if you were 50% levered, that could be a 40% hit to your value. So the private market did not correct as negatively as the public market, but I don't think it shot up as high as the public market either. So you're getting a little more volatility on both sides.
So you get a little bit more stability there.
A little bit more. I mean, at the end of the day, everything is correlated. Right. Interest rates impact the value of commercial real estate, no matter whether you're private or public. But the flip side, too, is the private market is actually much, much larger than the public market. As big as the public market seems, the amount of real estate owned in the private market just swamps it. There's so much more private capital in commercial real estate than you can even imagine.
So interest rates obviously affect your market. Do you do some type of, I want to use forecast projection, in terms of the direction of rates, how that might be impacting your market?
Well, we used to really think a lot about interest rates, and interest rates are super, super important to our business. But what I think we've learned over the last 5 or 10 years is we're all really bad at projecting where interest rates are going to go. Let's just be honest about that. And, what I would tell you is it will surprise a lot of people. But when you look at our business over the last 10 years, and we've had strong returns for a long period of time. Interest rates were low for most of that, which helped drive some of those returns. But the real driver of long-term returns is long-term rent growth. So it's been about demographics and rent growth. So in any kind of environment where rates are up and down and you see volatility, the one constant that helps you drive returns is if you have rent growth. Now, obviously, right now there's not any rent growth because we have a lot of supply. But like I said, there is a floor on the demand. And if you feel like we're moving into an era where that demand is going to stay consistent and deliveries are going to fall off for new units, you're going to have an increase in demand and increase in rents. And that's what I believe will really drive long-term returns more than where we are in the interest rate cycle.
Just fine tuning, because I totally understand your point, and I would 100% agree with you. But if mortgage rates, which are hovering around that 7% mark, do start coming down, because I'm sure, clients and viewers are interested. Well, what happens if your renters start buying? Is there an interest rate where you think the your renter gets a trade-off and doesn't want to rent and may want to buy the market?
Yeah, there's a potential trade-off. Surprisingly, when you look at the data over a long period of time, move out to buy has never been more than 15 or 20% of the people who are actually turning over and leaving. And so when rates are very low and home prices, if they're affordable, you do see that tick up a bit. But I think the only thing that'll happen this time around is as rates start coming down, mortgage rates start coming down, I don't think we're going to see any relief in home prices. And I have children who are in their 20s and early 30s who are in the market, want to buy homes. Saving now is tricky because the absolute value of homes in the markets they live in is really high compared to historical standards. So my personal belief as interest rates come down, and we believe we're in the beginnings of a long-term interest rate cycle coming down, though it's hard to know with the new administration, new policies, really where that's going to go. But I think our fundamental, baseline belief is that interest rates will be lower a year from now than they are today. That will create some more demand for homes, but we don't think it's enough to really change the demand demographic of this whole pile of renters because home prices are just too high. And I think as rates come down, more kids are going to try to get into it that are kind of on the edge and can barely afford it. But that's probably going to keep those prices high. You'd have to have interest rates low and home prices fall to really kick that off, which did happen in the Great Recession, but you're not seeing that this time around.
So you talked a little bit about how apartment prices came down and how that impacted your business. Can you correlate that to another time in history, or are we in a totally different period of history because of the size of the millennials?
I would like to correlate it a little bit to the Great Recession. The difference in the Great Recession, when asset values fell, they fell across the entire ecosystem, right? They fell in tech, they fell in healthcare, they fell everywhere. This is a very unique one where it's just specific to sectors that are interest rate sensitive. Commercial real estate has fallen. You've had issues with private equity, but you're not seeing those same issues across the whole market. And so it's been a bit of a more complicated time period because back then, when everybody was coming back together, there was a ton of demand for all sorts of investing. Right now, people are unsure. It feels like we should have been through a recessionary piece in our industry and then come out of it. Instead, it's just been this, it's been like we're in extra innings that just keep going. This is like the baseball game that never ends. It's unclear really when that whole recovery is going to pick up. And I've been hearing for a year from institutional investors like this is the time we're going to start buying. And we've seen some really big trades in the space. And you're seeing capital starting to come back in, but it's happening much more slowly than I felt like it did last time we had a major, value correction, which was at the Great Recession time period. And I think it's because there's just a lot more uncertainty today. I think last time everybody said, man, we're in the dumps. It's going to recover. This time people are like, well, the demand's there and it's going to get better, but I'm paying a lot. I'm still paying a lot. The values haven't come down as much as maybe they did last time. And so the investors are being a little more cautious about tiptoeing back into the market.
It sounds like you have very strong fundamentals behind your business model. And, I'm obviously on the public side. And the market's been confused because we had this inverted yield curve. History has shown every time we've had an inverted yield curve, we've had a recession. We didn't get a recession. We would have thought unemployment would have gone up. That didn't happen. And the economy is growing almost 3%, which nobody would have forecasted 2 years ago. And this consumer hasn't broken because they're still employed. Now, there is part of the demographic that's a little bit weaker on the lower income side. So I would say it kind of feels a little bit like Goldilocks. But I want to dive into what you said. You're starting to see other players now come into your market, bigger players. Can you kind of talk about that? What are they finally seeing? What are they starting to nibble at? Because I think this really gets to that the fundamentals in your business model are solid and they look like they're going to continue to stay solid.
That's a great question. And there were some really large transactions this year. Blackstone took Air, a public company, private. It was a very large acquisition. KKR bought a very large portfolio of multifamily. Brookfield bought another really large portfolio of multifamily. These are three very well-known, large investors basically saying, hey, I don't know if it's the all clear side, but values have corrected a ton. And we think the future looks really strong for this business. So let's buy now. Now, did they buy 6 months too early? Who knows? But I think if you look back at history, anytime there's a big value correction, especially in our business, the multifamily business is one of the most stable businesses that's ever existed. I mean, if you look back at rents over a 40-year period, I think we've had 2 time periods where rents were negative for like a year or two, and then they've just been positive, going, great inflation hedge forever. It's just been an incredible business. And I think those large real estate investors are making those bets because they're saying, man, values have adjusted. Let's get in now because we know 5 years from now, this bet's going to look really good. And it feels maybe a little early because you're dealing with peak supply being delivered today and you're seeing some pressure on rents. But people can see that by the end of 2025, it's like all clear again. There's no supply coming. No one's building. But which, by the way, the cost of construction is still through the roof. You haven't seen relief on construction costs, and nobody really is forming capital to do new deals. So nothing new even is penciling, because how do you build something new? Unless you're in an amazing location, right? And you're seeing a few deals get done, but generally speaking, the merchant people are out of the market because they can't build new and sell it for a profit when Blackstone's coming in willing to say, hey, I'm going to buy this whole company at a discount to replacement cost. And I think that's what the big players are saying. And so, we're selectively looking at deals like, hey, can we get something really good below replacement cost? And even if 25 is not going to be that great, we know 26, 27, 28 are going to be really good for the investment. And it feels like it's a pretty good time. And I think that's why capital's starting to come back in. They're watching the big guys, but they're tiptoeing. They're being careful. They're being very selective.
So let's talk about inflation. You kind of brought up inflation. I think this is an important topic, especially when people are doing their asset allocation. We're in that time of year where people are really looking at asset allocation. Real estate historically is a good inflation hedge. Can you talk about your business model and maybe as a client might be looking to add your type of portfolio into their portfolio? Are you a good inflation hedge?
I have a different point of view on this kind of after this last 4 or 5 years. Historically speaking, multifamily has been an incredible inflation hedge because we historically, over long periods of time, multifamily actually grows slightly faster than inflation, the rents do. And so that means you're having more NOI and more value growth than you're actually seeing on the inflation side. The formulas got a little messed up with COVID because we had this insane inflation, and then our rent growth was almost double what happened with the inflation. So you had this crazy demand spike happen right when you had inflation. And so you had this massive inflation up, but then you've had a value deflation come back down because of what the Fed has done with interest rates. So I think the market is finally putting itself back together. And in COVID, I mean, we've talked about this a lot with a lot of different people. Nobody could really predict all this weird stuff that came with COVID and the shutdowns in the economy. It feels to me like we're coming back to a normalcy, both in our business and in commercial real estate in general, where over a long period of time, 10, 15, 20 years, we're going to start behaving like we always have, which is a very good inflation hedge. You're going to have solid demand, solid rent growth. You're going to have nice, steady inflationary hedge growth, as part of a portfolio. And I, as an investor, I think like how much of my portfolio should I have in commercial real estate? Now, because I'm a real estate guy, I have way too much. I'm way too concentrated in commercial real estate. But I like it because it doesn't have the same volatility that my public market stocks do, or even my bond portfolio does. And it is really a long-term inflation hedge if you're in the right kind of assets. That's it. You got to be in something that stays full and can continue to grow. If you're in a single tenant asset and there's credit risk and that tenant goes bankrupt, you could have a real problem. But multifamily is not like that. You have 300 tenants. So if you have 1 or 2 people that don't pay the rent, you just refill them with somebody else.
So if a client walks in, a potential investor, what do you say to them to convince them or to have them consider investing in Cottonwood? Can you sell me, right? I'm the client coming in. Why do I want to invest in Cottonwood? What differentiates you from the marketplace?
Yeah, so I think there's 2 things. Number one, let's talk about why you should invest in real estate rather than in something else. I think real estate is an alternative asset class that does actually help you lower the standard deviation and volatility in your portfolio. So it'll actually help stabilize your portfolio long term to own something in the private markets. And then if you say, well, there's a lot of private market things that have all sorts of volatility and risk. When you start getting into real estate, the four major food groups are the least volatile, which would be like industrial, multifamily, traditionally office, though office has its own set of issues because of COVID and work from home. And then retail. Of those, industrial multifamily historically have been the most stable and the strongest, and they're all been really good inflation hedges. So I would say, from a portfolio construction standpoint, we're going to help de-risk your portfolio by diversifying into private assets that are inflation hedges. Specifically in the multifamily, I would say this is a time period when you can actually buy these assets at a discount to what it costs to build them. Like if I had to go today and rebuild my whole portfolio, it would cost me 20% more, 30% more than it's actually worth. And so you can buy in at this discount and you can see what's going to happen with demographics, and you're going to see what's going to happen with the rent growth. So I would say if you're willing to get in, who knows? I mean, we may be a little choppy across the bottom, but this is a really great time period because over the next 5 years, you're going to see really nice rent growth, and you're probably going to see the values come back closer to replacement costs, over a 5-year period of time. So it's a long-term investment. This is not a trade, right? And I think a lot of people who want to get in deals think, well, this is a trade. I'm going to get in. I'm going to get out pretty quickly. I think you have to think, hey, I'm building a portfolio. I want something that has, that will help me lower my risk in my portfolio, stabilize the returns, but also have nice long-term, return potential. And I think today is actually a really great time to do it.
So can you talk about liquidity? Right? The private markets tend to be a little bit stickier. You can't just go out and sell it right away. And do I earn a return as I'm investing with you?
You do. So as people invest, they basically are investing into the portfolio, and the portfolios, we're collecting rent every month, right? And we're paying the mortgages every month. And so you're getting the return on the assets every month, just like as if you were buying your own, duplex and renting it out. Now with us, of course, you don't have all the hassles of people calling you about, hey, the toilets are clogged. We deal with all of that, right? And we make sure that the proverbial trains show up on time to make sure the business works. And so you do get cash flow, and your return really is split between both appreciation and cash flow. And so some people look at real estate as a bond alternative. I think it's a little different than that, but it's similar. It's kind of in that similar vein, right? It's a yielding investment that someone's actually literally paying you, piece of the rents every single month.
So we've talked about a lot. What haven't we talked about that you think is important for our viewers to understand about multifamily and about Cottonwood?
Yeah, I mean, we have covered a lot, and I appreciate all the topics. I think one of the most important things to think about really when you're investing is really thinking about, hey, how do I construct a portfolio that actually helps me de-risk my life and take some brain damage out of my life? And I think private real estate should be a piece of it. I think part of the issue with the public real estate markets is they're just a lot more volatile. You still get the same exposure to the same kind of assets. And so if you're okay with the volatility, there's certainly more liquidity in the public markets. But the nice thing about the private markets on the real estate side is that the markets are really, really, really deep. I mean, we have a bunch of wonderful properties. Every time we put a property for sale, I've got 5 or 10 people who want to buy that. In the private market, there's plenty of liquidity long term. It just doesn't happen overnight. We just don't trade it every day. And on purpose, we hate selling assets because you can see, that what's going to happen over a 5-year period of time is you're going to have, higher occupancies, more rent growth. The values are just going to go up. You have all this fixed rate debt that's fixed. The equity just kind of slowly and constantly compounds. And I believe it's a really great place to park a piece of a portfolio. I wouldn't have a portfolio without some exposure to this sector. Now, some people say, hey, I want to own a condo and rent it out myself. I think that's the same kind of exposure. You just have to be willing to deal with the headaches that come along with that. We try to remove the headaches for you.
There's one other question that I thought of. Your background is actually Wall Street. Can you talk about your background and how that led you to become CEO of Cottonwood?
Thanks for that question. Yeah, I was an investment banker actually at Morgan Stanley for a bunch of years. And when I left, and we started Cottonwood actually 20 years ago, this fall, one of the things we wanted to do, what I wanted to do is I felt like often in the public markets, we weren't always in control of our own destiny because you had all this volatility, you had all this noise. I felt like, hey, if we're in the private markets, no one's going to tell us, hey, you have to sell this today. And no one's going to take our stock up or take it really far down. because it just doesn't trade. We're in control of our own destiny, and it felt like we had much more control over slowly and carefully building a portfolio of assets that were high quality and that would pay the rent. And there are always problems, there are always issues in any company, in any business. But I feel like because of the nature of it, we've been much more cautious about how we've been able to build and how we've been able to react. And I feel like we've had a lot more control over our own destiny versus, in a public company context, sometimes you lose control because of other factors in the marketplace. And, if you're a public REIT, sometimes your stock's out of favor and you don't really want to sell assets on the cheap, but you need capital because you got some issue going on, but your stock's, cheap. It's really dilutive. And you have all these issues. When you're in the private market, you just seem to have much more control over your own destiny over longer periods of time. And so from the beginning, we've always wanted to be private because we felt like we could control our destiny a lot better. And I've seen both sides of that story. And for me personally, I felt like I wanted to control my own destiny.
Well, this has just been a delightful conversation. I've always learned a lot about your market when we have a conversation. So thank you so much for joining us today.
Oh, thank you for having me. It's always a pleasure to see you.
And I want to thank everyone for tuning in.
Thank you for watching or listening to the Friends of Sanctuary podcast. Tune in next month to be sure not to miss out on the next installment of the series.
Securities offered through Sanctuary Securities, Inc., member FINRA SIPC. Advisory services offered through the SEC Registered Investment Advisors, Sanctuary Advisors LLC, and True Independence. Sanctuary Wealth consists of the wholly owned subsidiaries, Sanctuary Advisors LLC, Sanctuary Securities, Inc., and True Independence, as well as Sanctuary Alternative Holdings, Sanctuary Asset Management, Sanctuary Insurance Solutions, Sanctuary Global, and Sanctuary Global Family Office.